Now let's answer the question you've probably been waiting for. Can you really build serious wealth with a simple 3 ETF portfolio? Let's start with something incredibly simple. Imagine you're able to invest just $100 every month. That's it. Not $10,000, not $5,000, just $100. You invest it consistently, month after month, year after year, and you don't try to predict the market. You simply keep buying according to you. Now here's where things get interesting, because the real power isn't the first $100. It's what happens when your returns begin generating additional returns. That's compounding. Vanguard describes compounding as one of the major forces behind long-term investing. Returns that are reinvested can themselves generate additional returns over time. And the longer you give that process, the more powerful it can become. Let's use a hypothetical example. Suppose you invest $100 every month for 30 years, and your portfolio out-averages 6% annually. At the end of those 30 years, you would have contributed $36,000 of your own money. But with hypothetical compounding, the account could grow to roughly $100,000. That's the important lesson. You didn't contribute $100,000. Your contributions were only $36,000. The rest would come from investment growth. Now, obviously, 6% isn't guaranteed. Markets don't produce the same return every year. Some years could be strongly positive, other years could be negative. And inflation, taxes, fees, and investment performance can all change the actual result. So don't look at this number as a promise. Look at it as an illustration of what time plus regular investing plus compounding can potentially do. Now let's make the number more interesting. What if instead of $100, you invested $500 every month, using the same hypothetical 6% annual return and 30-year period? Your total contributions would be $180,000, but the hypothetical portfolio value would be around $500,000. That's the difference between simply saving money and giving your money the opportunity to compound. And remember, you didn't need to find the next Nvidia. You didn't need to predict the next recession. You didn't need to trade every week. You simply kept investing. Now imagine you have a higher income, and you can invest $1,000 every month. Over 30 years, that's $360,000 in contributions. At a hypothetical 6% annual return, that could grow to approximately $1 million. And this is where people often misunderstand investing. They think the secret is finding the perfect stock. But sometimes the biggest variable you can control is simply how much you invest and how long you stay invested. You can't control what the market will return next year, but you can control your savings rate. You can control your investment cost. You can't control your diversification. And you can control whether you panic during a crash. You can control your panic during investment cost. Those things matter. Look at these 3 examples: $100 a month, $500 a month, $1,000 a month. The difference isn't just the amount you're investing today. It's what happens after decades of compounding. And that's why starting early can be so powerful. The goal isn't necessarily to start with a huge amount of money. The goal is to start, then gradually increase your contributions as your income grows. But now, we need to talk about the uncomfortable part. Because your portfolio will not go up every year. There will be crashes. There will be recessions. There will be scary headlines. There will be days when you open your investment account and see a number much lower than yesterday. And this is where the lazy investor philosophy gets tested, because when markets fall, your strategy doesn't suddenly become wrong. The question is whether your original plan still matches your goals and risk tolerance. If you've built a portfolio that is too aggressive for your personality, you might panic, and that's why your asset allocation matters. Vanguard emphasizes that investors should consider their time horizon, risk tolerance, and investment objectives when deciding on their allocation. The perfect portfolio on paper is useless if you can't stay invested through difficult periods. Another temptation is trying to predict the perfect time to buy. You might think, I'll wait until the market crashes, or I'll invest after interest rates fall, or I'll buy once everything looks safe. But here's the problem. By the time everything looks safe, prices may already have recovered. That's why the lazy investor focuses on the process instead of prediction. Invest regularly. Maintain your target allocation. Rebalance when appropriate. And keep your time horizon in mind. Vanguard's own investing tools emphasize that asset allocation and long-term market exposure are central considerations when building an investment strategy. And now, here's the most important rule of the entire strategy. Don't turn investing into your hobby. That might sound strange coming from a finance channel, but hear me out. The purpose of building wealth isn't to spend your entire life staring at charts. It's to create financial freedom. You want your investments working quietly in the background while you focus on your career, your family, your health, your business, your goals, and your life. That's what makes the lazy investor philosophy so powerful. The portfolio is intentionally boring. And that's the point. So let's bring everything together. The lazy investor portfolio has 3 basic building blocks. Number 1, a broad U.S. stock market ETF. This gives you exposure to a wide range of American companies. Number 2, a broad international stock market ETF. This gives you exposure outside the United States. Number 3, a broad U.S. bond market ETF. This provides the fixed income portion of portfolio. The exact fundages are choices you need to make based on your own situation. The important thing is the philosophy: diversify. Keep costs under control, invest consistently, rebalance when necessary. Stay focused on the long term. Do you really need 50 stocks? Probably not. Do you need to predict which company will dominate the next decade? Not necessarily. Do you need to watch the market every single day? Definitely not. What you need is a strategy you understand, a portfolio that matches your risk tolerance, and the discipline to keep following your plan. Because wealth isn't usually created by one brilliant investment decision. It's often created by thousands of small decisions repeated over many years. A contribution this month, another contribution next month, another one next year, and eventually, those small decisions can become something much bigger. Now I want to hear from you. If you had to choose, would you rather build a portfolio with 3 simple ETFs or actively manage dozens of individual stocks? Let me know in the comments. And if you want more videos about building wealth, investing, ETFs, and long-term financial freedom, subscribe to the channel. Until then, remember, you don't need to predict the future. You just need a plan. You just need a plan and the discipline to stick with it. This video is for educational purposes only and is not personalized financial advice. Investment returns are not guaranteed.